All right, let's talk about the market. If you've had an eye on the indexes this week, you've definitely felt that little dip in your stomach. The bulls and the bears are locked in a serious showdown. And today, we're going to break down exactly what's going on, what to watch for, and how you might play it. It really all boils down to this one number, 24,500. Now, this isn't just some random figure. It was a massive psychological and technical line in the sand for the Nifty 50. And the fact that we broke below it, well, that's what's sending a few shivers through the trading community right now. So, what just happened? For weeks, the market felt unstoppable, right? But this past week, the Nifty 50 finally gave the bears what they were waiting for. It closed below that critical 24,500 mark. And in market language, a break like that is a huge signal. It suggests the whole mood might be shifting from, buy everything to, uh-oh, let's be careful. And here's the thing, it wasn't just about the big blue chip stocks. The selling was actually even heavier in the mid-cap and small-cap spaces. Now, that tells us something interesting. It suggests this wasn't necessarily a full-blown panic, but more like widespread profit-taking. You've got investors who've had a great run deciding, you know what, it's time to cash in some chips. Okay, so to figure out what might happen next, we need to get a handle on the two forces that are basically running the show right now, support and resistance. If you can get your head around these two ideas, you can pretty much read the market's mind. First up, let's talk support. The easiest way to think about it is like a price floor. It's that level where a stock that's been falling suddenly finds its footing. Why? Because buyers start seeing it as a bargain. They jump in, and that sudden demand supports the price and hopefully stops the bleeding. And on the flip side, you've got resistance. That's your price ceiling. As the market claims higher and hits this level, sellers who bought lower start thinking, this is a great place to sell and lock in my profits. That flood of supply acts like a lid, making it really tough for prices to push any higher. So this brings us right back to the current tug of war. The market is basically stuck in a box. The new ceiling, or our immediate resistance, is sitting around 24,550, and the super important floor, our immediate support, is down at 24,000. For now, all the action is trapped right between those two levels. And this leads us to the biggest question of the week, right? What on earth happens at 24,000? Seriously, all eyes are on this number because it's the market's new fork in the road. From here, things can really only go one of two ways. Let's start with the happy path. Scenario number 1, the bounce. In this version of the story, that 24,000 level acts like a trampoline. Buyers see this as a great price, they pile in, and that demand is enough to push prices back up. If that happens, we could see a really nice short-term rebound, maybe right back up towards that 24,550 ceiling we just talked about. But what if that floor isn't a trampoline? What if it's thin ice? In scenario 2, the sellers stay in control and the Nifty punches right through 24,000. If that floor cracks, it's a major sign of weakness, and analysts are saying the next logical place for the market to fall to is all the way down at 23,800. Okay, so theory is one thing, but how do you actually play this? It's not about just watching the drama unfold, it's about having a game plan. And your strategy really depends on who you are as an investor, so let's break it down for 3 different types of people. First, let's talk to the fast movers, the short-term traders out there. You know who you are. The ones who are in and out of the market, sometimes in the same week or even the same day. For you, the approach right now should be all about one word: caution. For you active traders, the advice from analysts is pretty blunt. This is not the time to be a hero and try to catch a falling knife. The risk of getting caught in a bigger downdraft is just too high. The smarter move is to sit on your hands, be patient, and wait for a clear signal, like a decisive move back above that 24,550 resistance before you even think about aggressive buying. But hey, what if you're not trading every day? What if you have a longer view? Someone who's looking to hold on for a few months. For you, this little dip might not be a threat. It could actually be an invitation. For you, this dip could be a real opportunity. But, and this is a big but, it's all conditional. If, and only if, the Nifty holds that 24,000 floor, then this could be a great time to do some staggered buying. That means you don't dump all your cash in at once. You buy in smaller chunks. And you've got to focus on high-quality, fundamentally strong companies, not just the junk that's falling the fastest.
And finally, what if your main priority is just not losing money? For the super cautious, defensive investors, this kind of shaky market means one thing. It's time to put your shields up.
The advice here is really simple. Protect what you have. That means keeping your stop losses incredibly tight on any positions you already own. And whatever you do, resist that temptation to go bargain hunting in those beaten down mid and small cap stocks. Let the dust settle first. Now, what's fascinating is that even with all this nervousness floating around, sharp analysts are still finding potential gems. They're digging for individual stocks that are showing real strength, kind of like they're swimming against the current. So let's see what's on their radar. Okay, one name that's definitely standing out is Dr. Reddy's Laboratories. One analyst, Sumit Bagadia, has laid out a super specific plan here. He suggests buying in around the 1,211 rupee mark, with a target price of 1330, and crucially, a stop loss at 1,150 to make sure you protect yourself if things go south. And it's not just Dr. Reddy's. Analysts are also pointing to HDFC Life and NTPC. Both of these companies have been flagged because their charts look really strong. It suggests they might just have what it takes to power through, or even climb, while the rest of the market is wobbling. And so, we end up right back where we started. The market is standing at a crossroads. And the answer to this one huge question, is this dip a warning shot, or is it a golden window of opportunity? It all comes down to whether that 24,000 floor can hold. So keep your eyes glued to that level. Thanks for tuning in.